Web 3.0. You're probably hearing about it everywhere. What the heck is it? Is it worth investing in, or is it all hype? And why is it stirring up so much drama between tech elites and investors? Hey guys, and welcome back to Roundup Save. In today's video, we're going to be cross-examining Web 3.0 and looking specifically in the context of history. History is one thing that stays constant and can provide some answers despite the emergence of new technologies. As you may have noticed, there's a lot of money starting to go into Web 3.0, and I wanted to dig into the topic for myself to really understand more about it. Stick around to the end of the video to hear my thoughts on whether it's worth investing in or not, and exactly what I think is a good approach to do so. Without further ado, let's dive in. To actually understand Web 3.0, we have to understand Web 1.0 and Web 2.0. Between 1991 to 2004, Web 1.0 was really in the early days of consumer adoption of the internet. People just started browsing, websites were popping up left and right, and adoption was making it really appealing to investors and entrepreneurs. Web 2.0, which emerged in 2004 and has been going all the way through present day, was the centralization of web services like Google, Facebook, and Amazon. And fundamentally, they allowed people to transact, connect with each other, and learn, but it was all under watchful eyes. These super companies basically control the flow of most money and information on the internet, and they use data based on our behavior to serve ads with the intent of increasing purchasing. This is where we are now. Web 3.0, in theory, would be the decentralization of these web services. Built on blockchain technology, which makes all transactions and ownership completely transparent, would mean that the power goes back to users and supposedly cuts out the middlemen and centralized institutions, such as banks and governments. There's a handful of applications that Web 3.0 could potentially have. The first one is that when it comes to transferring money, it's a huge hassle in today's day and age to do so. We have to go through a bank, there's transfer fees on occasion, there's also waiting times to transfer the funds. And so with Web 3.0, this would be instantaneous. Secondly, your digital identity would remain anonymous. This is a good thing, or it could be a bad thing depending on how you look at it, but that's how it is. Another thing is that no company like Facebook or Google could take down your posts. And again, that's a good thing or a bad thing depending on how you look at it, because it could encourage free speech, but it could also incite more hateful speech on the internet. And among one of the biggest applications that's being talked about when it comes to Web 3.0 is the Metaverse. The way that I think about the Metaverse is it's essentially like our social media of Web 3.0, except you would be more immersed in the space. By immersed, I mean you probably plug in with a VR headset and it would be much more engaging in theory. You might be able to buy digital real estate, for example, and as Mark Zuckerberg, the founder of Meta, formerly Facebook, puts it, you might be able to teleport from different destinations. You could rent out a virtual Airbnb, and the list goes on. As you might expect, there's a lot of money pouring into the space, both from mainstay companies as well as consumers. Just a few companies to note that are getting in on the action are Nvidia, Microsoft, and like I mentioned, Meta, formerly Facebook. Now that we've defined what Web 3.0 is, we can actually start to look at history to understand what might happen. So with the emergence of new technology, there is always some level of speculation about its future applications and its hype that has to be reconciled with how the stock market actually behaves. So there's two things that typically in this environment need to be weighed out. One is the current economics and the reality of the technology, where it stands and its timeline in terms of being developed. And secondly is the future valuation. It could invite the potential for an asset bubble, which in other words is basically buying fueled by FOMO. If you're not familiar with what an asset bubble is, it's defined like this. An asset bubble occurs when the price of an asset, such as stocks, bonds, real estate, or commodities, rises at a rapid pace without underlying fundamentals, such as equally fast rising demand to justify the price spike. In this case, this could mean the readiness of the new technology for consumer adoption and profitability. I should clarify that this doesn't mean that the new technology doesn't serve a purpose. It's just simply that we don't fully understand how it's going to play out. And some of the things we think might be big today just may never come to fruition. All right, guys, time for a history lesson. During the 90s, the internet was really starting to bubble up, and it was becoming a big thing in terms of consumer adoption. more people were finding themselves online, and investors and entrepreneurs alike were starting to get in on the action. We were seeing .com this and .com that starting to pop up everywhere, and investors were just throwing money because they thought this could mean big profits in the future. However, it led to a big bubble, and the bubble ended up bursting in the early 2000s. After everybody stopped drinking the Kool-Aid and kind of came to their senses, there were a few big realizations. The first was that many companies simply did not have an adequate business model that would translate well to use with the internet. For example, some companies were just simply not making things more convenient for consumers compared to traditional retail. Take Pets.com, for example, arguably the biggest flop to come out of the .com bubble. Shipping times for their products were more like 7 days compared to what we've become accustomed to with Amazon's 2 to 3 day shipping times now. If you were a pet owner, why on earth would you want to wait 7 days at that time to get dog food or medicines or whatever it was versus just going to the store? It's probably much more convenient for you to just drive to your local store, get the supplies there, versus having to wait a whole week. Another point is that the principles of demand just simply were not there. As a sector, internet company profits simply did not match up with what their stock prices were valued at. For example, you can see here that the market cap of internet companies was significantly higher than what their profits were during the .com phase, and it took really until 2009 and onward for those profits to match up with what the valuation of the sector was. If we go back to 99, we can also see that the price to earnings ratio of these companies was 60 times versus more recently in 2017, it was about 20 times. In general, a higher PE ratio means that there could be higher volatility due to either one, overvaluation of a company or a sector, and secondly, expectations of high growth rates in the future. As a consequence, companies were employing growth at all cost tactics, such as spending unruly amounts of cash on marketing and also selling units at a loss. Even Pets.com had a placement in the Super Bowl. It was insane. Coming back to Web 3.0, we can see that it still has a ways to go despite the promise of all of its future applications. There are broadly 3 categories of challenges and questions that I think of that may change over time as things get addressed. But for now, this is how they stand. I can't take credit for all of these, but if you're interested in diving a little bit more into each one specifically, let me know in the comments down below and I can make some follow-up videos. So the first category has to do with technical challenges. Stephen Deal, a software engineer in the fintech space, has been a pretty vocal critic of Web 3.0 and blockchain. And he has a blog where he posts essays on his thoughts. As he states it, Web 3.0 has 3 technical issues: a compute problem, a bandwidth problem, and a storage problem. Blockchain networks, which form the base for Web 3.0, are expensive to run from a computational perspective. And this has really driven up the cost sky high, which Deal argues is simply not scalable and would require some level of centralization to improve efficiencies. Second, who will actually be the customer support for Web 3.0 if it's to be fully decentralized? He brings up some very legitimate questions, like who's going to pay for the global data centers to serve content? Who's going to ban the Nazi accounts? And who's going to reset grandma's password when she forgets it? If these questions are going to be answered, they will require some level of centralization, and as Deal puts it, you've just recreated Facebook by another name. Lastly, who actually owns our data? Every business is going to encounter this problem from a customer data visibility standpoint because they need to decide who to let in and who to keep out. And this would pretty much mirror some of the stuff that we see today with Facebook and Twitter in terms of deciding who they're going to ban and who they're not. Another example of the question around data storage is if we look at Coinbase. Coinbase is the first crypto exchange to go public, and as of today, considered by many to be the most secure way to buy and sell crypto. And it's also never been hacked like some of the other crypto exchanges. Here's the thing that I find kind of strange about Coinbase. Despite the fact that Coinbase is selling decentralized cryptocurrencies, the kind of strange thing about it is that you can keep your money in Coinbase. And I should note that Coinbase, of course, has other options for you to transfer your funds into private wallets, etc. But for the people that do keep their funds in Coinbase, it's really similar to keeping your money in a bank. So while you technically own the money, Coinbase, just like a bank, could freeze your account and your assets at any given time if they are required to do so by a sanctions program or a court order. Just as I show here, it's listed on their website. Moving on, we can consider hardware and design to be a challenge as well. Another thing is that people just may not want to be wearing VR headsets all day. Like, you know what I mean? They're pretty bulky, and while they definitely have become more comfortable over time, they're still like just giant things in goggles that you wear on your face. And I don't know if I'd personally want to be doing that yet. And you also need a lot of space to be able to move around and move your arms and stuff like that, which you just may not always have access to. The Wall Street Journal has a hilarious quote that kind of sums all this up. And it goes like this: "Having a fencing match with a virtual opponent in the middle of a tropical rainforest may sound appealing until you accidentally trip over your real world coffee table. Yeah, then you're screwed." There's also a lot of question marks around social anxiety and isolation, mental health, etc. And if Meta, formerly Facebook, is designing, the new iteration of their product in Web 3.0, I have a lot of questions because they did a lot of stuff in Web 2.0, as we know, with the Facebook files, etc., that has a big impact on mental health. So I definitely am skeptical on that point. Finally, the third broad category is what I consider existential threats and ethical challenges. Let's look at Bitcoin, for example. A recent study has shown that 27% is owned by 1%. And to me, that kind of reflects our income inequalities in the real world simply persisting themselves in the Bitcoin virtual cryptocurrency world. There's some level of centralization when that happens, when you have 30% of the assets being controlled by 1%. Buying things as we know them in Web 3.0 will use some combination of traditional cryptocurrencies like Ether and Bitcoin, as well as transferring cryptocurrencies into Metaverse tokens. There's definitely going to be some friction between the fact that we live with a centralized government that has a centralized bank, aka the Fed, and using these decentralized cryptocurrencies to buy things in Web 3.0. We need to reconcile them in some way, and this may not look very pretty. For example, as billionaire investor and author Ray Dalio puts it, the US government could outlaw cryptocurrencies just like they outlawed gold in the past. We also know that the Fed is exploring ways to create a CBDC, or a central bank digital currency, which would basically be the digital equivalent of cash. So we've looked at a few things so far. We've defined what's Web 3.0 in the context of Web 1.0 and 2.0, and we've also thought about what are some of the historical challenges with the dot-com bubble, as well as how do maybe some of those, pop their ugly head out when we think about the technology that Web 3.0 is supposedly supposed to be creating. In summary, there's still a lot of issues to be worked out. Not necessarily a bad thing, but just something that we need to keep in mind about. And those, all have to do with the investments required to make this thing work, costs, and the ethics. Particularly from the consumer side, this just may not justify the hype that's gone on around Web 3.0. So here's my stance. I think you, nor me, nor anybody else knows how Web 3.0 is actually going to play out. But I do think that critical questioning from a very early stage, as we are in now, is the right approach. Especially if you're putting in money, you have an obligation to yourself to ask questions and to try and understand, is your money actually going to have payback or not? If we look beyond the short term, make a quick buck mentality, I'm definitely skeptical, but somewhat optimistic at the same exact time. I think the Web 3.0 that's being sort of planned out today is going to look very different than the future and how it actually materializes. Just like the dot-com bubble, many things that seem cool about the metaverse and Web 3.0 today will likely die off, and the things that actually have stickiness factor and consumer demand associated with them are going to stay around. For those reasons, if you're evaluating any companies that are getting into Web 3.0 or you're hearing about them, definitely take a critical eye. I think it's okay to maybe invest a little bit, but don't invest much, at least right now. But as always, do your own homework, do your own research to help make your own informed decision. It's very possible that I could be asking the completely wrong questions, and if that's the case, let me know down below. Let me know if you have any resources that might be helpful for me. Guys, thanks so much for watching, and if you like this content or you like more of this kind of deep dive content, go ahead and hit that like button and subscribe to the channel down below. Drop any comments if you have any questions at all about anything that was talked about in the video, or like I said, if you have more resources or Anything you'd like to talk about when it comes to Web 3.0, Metaverse, cryptocurrencies, whatever it is, I think it's all worthwhile to be chatting about. As always, have a great day, and we will see you next time.